quite simply, money moves markets. It's not money in the real economy that moves financial asset prices, it's money in financial markets. What we do is we spend a lot of time monitoring flows in financial markets. That's not M1 or M2, as is sort of the conventional monetary aggregates. Those refer much more to retail money that is in banks, high street banks that drive the real economy. If you want to know what's going to happen to inflation and the real economy, take a look at M2. If you want to know what's going to happen to financial asset prices, don't bother about M2. Start looking at financial liquidity measures, how much money is sloshing around in financial markets, and that really matters. What the Federal Reserve and other central banks are doing right now is pulling vast amounts of money out of financial markets. They're making them pretty illiquid, and they're delivering a massive wealth destruction. As of the end of October, partially the latest rally in markets, but as of the end of October, the central banks had managed to destroy a whopping $29 trillion of wealth so far this year in the world economy. That now beats the wealth destruction in 2008 in the global financial crisis. It represents about 25% of world GDP. These are significant numbers. And the reality is that probably too much liquidity has been squeezed out of financial markets. They've created illiquidity. The problem is they've created a lot of illiquidity in the sovereign debt markets. Rather, unlike 2008 and earlier crises, the fundamental problems are not really in the credit markets this time. There are pockets of problems in real estate or credits, I accept, but it's really in the sovereign markets. And you can see that in a chart that I think you can put up, which is looking at a measure we give of market liquidity, which is based on analyzing the US Treasury market and the US Forex market spreads. What that shows is significant declines in liquidity this year. But for comparison, we compare that with what happened in 2008, and you can see the profile is not dissimilar. But in 2008, there was an up leg as the central banks were forced to come back in. And I think that's the thing that we've got to start thinking of right now. Our view is that there is a pivot coming. That pivot is not because of problems in the real economy. That is likely because of building problems in financial markets. And if you want evidence of that, listen to what Janet Yellen was saying 2 or 3 weeks ago about problems in Treasury market liquidity, or more pointedly, look at the alacrity with which the Bank of England jumped back in, reversed its QT, started to do QE once again to save the sovereign debt market in the UK. This matters for central banks and for treasuries. It's a big, big issue. And whatever one may say about the merits or demerits of inflation rising or falling right now, the big issue out there, the elephant in the room, is the fiscal problems that are emerging on the horizon.